Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go over kind of increasing interest rates. We'll look at kind of the situation we have in energy around the world, in prices, in demand, in supply. I'll go over a little bit of kind of what the current paradigm is, the way that people view things. I'm going to go over what the returns were in the 1970s of different assets. And I'll kind of all tie it up with my opinions and interjected all through here. So there are some things that I somewhat disagree with that are kind of the norm of what people think is normal, and I want to show you the differences between what I think is different and what kind of normal thought is, and what I think is different with that normal thought and why I think so. So let's dive in here, show you what I've got. I kind of put it in a PowerPoint with a bunch of different slides here. So let's dive in and take a look of what I'm talking about here. So this is the effect of increasing on interest rates. And I'm going to talk about the current paradigm versus kind of what I think is a little bit different given the market conditions this time around. And it may or may not have an impact, but this is kind of what people think. This is the effect on increase in interest rates. The personal effect is it increases the cost of borrowing. It improved return for savers. It's a higher mortgage interest payment, increased cost of bank loans. Banks may be more willing to lend because of the higher interest rates, and could reduce confidence of borrowers. The impact it has on an economy is currency will appreciate, making exports less competitive, imports cheaper. Inflation will tend to be lower. Economic growth will tend to be slower. Unemployment could rise, and the government will see rising borrowing costs. And usually what I've seen in history, and this is kind of the current paradigm that we have, and this is what people think, and I agree with the majority of it. And if I'll do one other slide before kind of get into what I think, but here's the real CRB spot commodity index. Under inflationary periods, commodities do very well. They do poorly under disinflationary or deflationary environments. The paradigm that whoever created this chart, they think easy money, tight money, easy money. Notice the time frames from 70 to 1980, 80 to 2000-ish, and then from 2000-ish on, they had easy money. Well, what does that mean? I thought easy money is low interest rates. Well, this was an increasing interest rate environment here. That was the increasing interest rate environment of the 1970s. That wasn't easy money, was it? Tight money, well, this was a disinflationary environment. This is a lowering of interest rates. Why would they think tight money if there was a lowering of interest rates? And then we increased interest rates during this time frame. I think they may be off in what both of these will necessarily mean, because inflation will tend to be lower off of increasing interest rates. I don't think that's necessarily right. Same with this. This is what they're showing and projecting, and I don't think this is necessarily right. So what is right? Well, when I look back and I looked at the data and I looked at demographics, and what I'm looking at here is the annual percent change in the US population. What you want to look for are large demographic shifts where it basically goes up in percentage terms and slaps the world, slaps it in the face, so to speak, with a much larger demographic. It's the step change in demographic. And the step change does also accompany a volume, a difference in volume, because it's a percentage of the volume. So we're looking at a step change that slaps people in the face. And if you add 30 years to these numbers down at the bottom, this is the population of when they're born. But what matters is the credit expansion of when they're 30 years old. That's kind of the average age of the first-time home buyer. So you get 40 plus 30 is 1970. 40 plus 50 is 1980. The disinflationary, quote, tight money is the disinflation. It's the drop in the growth of the population. This is a high growth of the population coming into home buying years. And we've got that here as well. You add 30 years to 1990, that's 2020. That's basically here. And then you go all the way out till, I don't know, probably 2025 or so is this kind of impulse of buyers coming into the market. We also had a shortage of homes at the beginning of it. So the tight and easy money has nothing to do with interest rates, in my opinion, and has everything to do with the demographic. And I will tie this all to today's in market conditions and environment, but you first have to understand this that I'm showing here first is demographics drives the inflation, disinflation, and inflation movements with a 30-year lag. What that means is we know what's coming even behind this, which will probably be from a credit expansion phase, more disinflationary from credit expansion. It doesn't mean that the CPI will necessarily go down because that is measuring something that's different than just the inflation or the increase of credit in the system. So this here is the increase of credit. This is the slow decline in inflation from the credit. This here is an increase of credit. It's a slap in the face of a larger demographic coming into home buying years. And it may be delayed a little bit to the right as people delay family formations and home buying into later stages of their life. Now, this demographic change, if we were to just use this clip, would mean that in the 1960s, we started an inflationary period, late 60s to 1980, roughly. And then another inflationary period, there's a little kind of move here. That's the year 2000. The year 2000 up to probably the year mid-2000s would be another kind of demographic buying pressure. And then you've got another one here. So we would see with a 30-year lag that from 1969 to 1980, we'd see an inflationary period. A decline in demographics would be a disinflationary period. The year 2000s would be another inflationary period, which we saw there, which is this little movement here. And then we're seeing that other movement here, which is this movement here, 30 plus 90 is the year 2020. There it is. So this is your inflation with your CPI. What happened looking backwards is we had plentiful energy. We had plentiful commodities that we could just grow into. So really the things that you want to look at if you're looking at what is driving something is the demographic was driving the inflation because that's what we'll call it the variable was. The variable was the demographic and the variable was how much money was in the system or not in the system. And a variable with commodities, since they were so plentiful, that was not really a variable because you could just grow. They were out there. You could grow very easily. They were cheap. New mines came on. It was high ore grades. We had plentiful energy and plentiful commodities around the entire world. It wasn't really a variable in the past, and all that we could do was basically control whether the demographic could afford to buy it or not. So what happens is inflation would come into the system from the new demographic right here, and interest rates would follow this inflation higher in our current system. And that interest rate would have impacts on people deciding to buy things or not. It would slow the money down a little bit. But the demographic could overwhelm that interest rate if it was a large enough hit or a large enough, big enough impact to the world, that demographic. And this demographic will impact whatever currency it has. You know, if Canada, which Canada has a larger demographic coming into home buying years, their home prices went up quite a bit. So it's demographic driven, is what I found. Now, what's coming into play now is another variable. We saw it in the 1970s, and it impacted the inflation of that time frame. So they had a double whammy in the 1970s. They had the demographic coming into home buying years. So basically, money was coming into the system through credit growth, new loans, against new homes, and the credit growth. They also had a constraint in 1970s where oil peaked out and started to go lower. This here is your oil production in the United States. It peaked and it started heading lower. But we could import more oil during this time because we had spare capacity throughout the world. So it wasn't really the end of the world, so to speak. This here was more of a localized problem, but it still was felt in the 1970s. So in the 1970s, we had the demographic and crude oil production peak at the same time, which led to these large inflationary numbers measured through the consumer price index, the purple line here. So it was a mechanism where money was coming into the system. Historically, that was the only kind of variable was the demographic and money coming into the system. But this time in 1970s, we had the demographic and another variable, which was peak oil in the United States. So we had those two things come in together to create a very large inflationary move measured through the consumer price index. Money came into the system, and the thing that transferred that money into the CPI was oil. So that was something that was different about the 1970s versus other periods. In the 1970s, if you were to look at total returns after inflation, energy stocks obviously did quite well. You were in an energy crisis type environment. REITs also did very well, and then everything else kind of didn't do very well. They all went down in terms of total returns after inflation. Now, what I'm looking at is the barrels found here. This is oil. This is barrels found, and then production that's coming up, consumption and production of oil after. This is in million barrels of oil per year. This is newly discovered oil fields. And the thing that I want you to kind of grasp from here is we found a bunch of oil all the way up to about 1980. Then we had a drastic decline in oil discoveries and are still declining over time. At some point, when we are consuming more than what we are finding, we are basically eating up our inventory of discovered oil. We will peak and roll over. And our first kind of lesson with this, looking at history, was when you have a larger demographic coming into home buying years, that inflationary move comes in from credit growth. The second thing that hits is all that money's in the system will rotate over when you have an energy crisis like the 1970s and peak oil in the United States. So that is our first run. The second run now is going to be on a global worldwide basis. A global worldwide basis where oil peaks and then other energy sources also could potentially peak. And we know that we're eating through our discovered oil already, and we're not finding enough to replace what we've been eating up. So I think that we are in a global energy crisis. This is what it is here. Petroleum geologists predict peak oil soon. They don't know exactly when the date is. They have 2010, 2011, 2020 here. They don't know necessarily the exact peak and how much oil is necessarily out there in its entirety, but I think we're getting closer and closer, quite obvious, and it should happen over the next 10 years. I don't think that we can continue this production growth like we did in the 50s, 60s, 70s, and 80s, and even in the 90s and 2000s. I don't think that can continue where we double our oil production growth again. I don't think we can double. I don't think we can go to 200 million barrels a day. I don't think it's out there. So in order for us to have GDP growth from oil at, say, a 3 or 4% year clip, I don't think we can double oil production for that to happen. So we're going to hit an energy crisis at some point, and the money in the system, which they've been printing copious amounts of money, will transfer into those consumer price index numbers. Now, we've got large rates of inflation right now. It is very large. we are coming into a home buying demographic in the United States known as the millennials. So we should be pumping flat out, right? And we have been pumping, and demand should be just going up. But here's the thing that I notice. Chinese cities rush to lock down and show of loyalty to however you say his name, zero COVID strategy. That was September 5th, 2022. They're in lockdown. We have high energy prices, and these guys are all in lockdowns. It says more than 70 Chinese cities have been placed under full or partial COVID lockdowns since late August, impacting more than 300 million people as local authorities rush to stamp out infections at all costs in the final countdown to leader Xi Jinping expected third term. So they have 300 million people on lockdown. That's basically all of the United States size almost. And this here is basically demand that they're slowing down. And we've got in Europe, more smelters face closure as Europe enters power-starved winter. We've got all these closures of high energy intensive businesses shutting down. So demand is literally very low when you look at it from a worldwide perspective. I know that the demand is almost back to 2019 levels, and that's with the Chinese on basically lockdown on 300 million people. And when you look at the energy prices, this is natural gas, EU, Dutch, TTF. These things have done vertical things. And if you were to kind of zoom out even further, this thing's gone vertical, guys. So we obviously have a problem in natural gas in Europe. That's quite obvious. Russia did shut down the flow of it there. We've got crude oil that's pretty high in relationship to history. It went all the way up to hundreds. In the hundreds, it's pulled back to about 86. We've got natural gas in America that's also being impacted and getting pulled higher as well as we ship our natural gas around the world through liquefied natural gas plants. We're also seeing coal go through the roof as well. I've seen China is obviously increasing their coal use dramatically. Same with America and everywhere else. So when we look at all this stuff here, and we look at the kind of scenario here, we've got demand that's basically being delayed or slowed down through those lockdowns in China. We've got energy prices all over the place going vertical everywhere. And we're seeing that in our consumer price index inflation numbers. We're seeing that money. So their game plan, the game plan of the Federal Reserve, is to do what they did previously, and that's to destroy demand through interest rates. They need to slow the money creation into the system because they can't control the prices in oil, natural gas, and coal. And what I think is going to happen is when the Strategic Petroleum Reserve release ends and these liquefied natural gas terminals come online, that we are going to become more interconnected throughout the world. I think it's going to push prices higher in America, and over in Europe, it's probably going to come back. So those pressures, the supply pressures in the system, I don't think they necessarily can control it, the Federal Reserve. All they can play with is the demand. And historically, when that was the only variable, I think it worked quite well, or could work. What it basically came down to was the demand from the demographic, and if the demand was large enough, it could overpower that inflation, the interest rate, and delay it until that demographic basically ended. It ended in 1980. The demographic rolled over, and I don't think that interest rates were necessarily the only factor that got inflation under control. It was the demographic running out. Now, we've got a demographic that is larger coming up, and we've got a supply problem in energy. So that is what's going to transfer the inflation into the CPI. And what they're trying to do is use the variable of higher interest rates to kill the demand. But we already have demand being killed all over the world. We have people on lockdowns and all that other stuff. So now it's, what is the supply response? And if there is no supply response, and if they are messing with prices of oil, what you're going to see is the supply actually decline. So now you're not playing the game of killing demand. You're playing the game, is supply getting withdrawn from the system faster than the demand, you would still have an increasing price then. And how close are we to peak oil? I don't necessarily know, but this whole mix is a little bit different than what it was in previous, the year 2000s, 2008, 2007. It's a different type of environment today than it was back then. So it's more of a supply driven problem. And I think the supply is going to get worse, not better, as time goes on. I also think the supply of more commodities are going to hit peak. So I think that, and I know a lot of people talk about the investment, that we have underinvestment. Well, at some point, no matter how much money you throw at this, it will decline no matter what. You're just going after lower and lower oils. Now, I don't know if we're there yet. Maybe that's 10 or 20 years out. But it's good to know this and understand this. It's good to see what the market conditions are bearing here. But we have a supply problem. And if we did not have a supply problem, would we have the problems we have today? No, we wouldn't. If we didn't have supply problems to Europe, then a lot of this wouldn't be going down. And I think that Europe will definitely go through a recession. It's inevitable. They're shutting too much stuff down and the prices are too high. That could impact America. Right now, we're sitting pretty well. And any recession, I think, was going to be pretty small. But with the impact of Europe, maybe it is a little bit larger. And we'll have to see. But right now, things are being driven by energy. That's where the problem and the root causes are. You can see it in all these numbers. Now, if the lockdowns come undone and they start increasing their demand, you could see higher prices. When China basically ends their lockdowns. So there is delayed demand. It is out there. And right now, we'll see what happens in the markets in terms of energy. I still think it's a tight market. I think when the Strategic Petroleum Reserve release ends, we're going to see potentially higher prices. So till then, if you guys like the content, give me a thumb up. Subscribe to the channel if you haven't. Subscribe to the website, the Platinum membership, if you want to know how I'm playing this and which energy companies are my favorite. And we'll catch you next time. This is Finding Value.